Indian equity markets are on a record-breaking run. For a third consecutive day on Tuesday, the S&P BSE Sensex claimed a fresh lifetime high, topping the 62,800 level intraday. The Nifty 50, meanwhile, topped the 18,650 mark for the first time ever yesterday. From the June 2022 lows, the frontline indices have gained around 18% each, outperforming their global peers by a wide margin. Risks, however, are now emerging for the markets. Nifty 50's valuation has expanded to around 19.7 times, which is 22% above its long-term average. According to Kunal Vora of BNP Paribas Securities India, the bond earnings yield gap has widened to minus 2.4%, which is around 120 basis points, below its average of minus 1.2% since 2009. Historically, at this level of gap, we have seen negative one-year forward returns. Vora says there are limited positive catalysts for any meaningful earnings upgrades, with risk skewed towards the downside. Economically, analysts fear the ripple effects of a potential slowdown in global growth may be felt in India in 2023. Goldman Sachs, for instance, expects growth in the Indian economy to shrink to 5.9% next year from 6.9% in 2022. Waning reopening boost and monetary tightening may cripple the growth in the first half of 2023. But growth engines may pick pace in the second half as global economy recovers, drag from net exports diminishes, and the investment cycle picks up. The third potential threat that investors need to be wary of is a possible change in the capital gains tax structure in the budget in February 2023.
In my viewpoint, I think the holding period might probably increase from 1 year to say 2 years or 3 years. And should that be the case, then in my view, I think nothing goes negative, because longer the holding period, probably I think better in a way that I think people will hold on to equity for investment as well. Currently, most of the, including funds, I think they are trading around equity, I think very significantly. So quite possible, I think that is going to be an outcome, which is a good investment cult as well. Now, whether they are increasing the rate as well, and if the rate increase, I think, is brought at par, I think, for short-term capital gain times, so be it. I don't see too much of a problem either. But I guess I think they will have to create the differentiation, because if you are increasing the period, then probably the rate will have to be differentiated from short-term capital gain times. Not too much of a worry, because in the past also we have seen that whenever the tax rate has been increased, initially you will cry, but thereafter market has settled down and accepted it.
According to media reports, besides the rationalization of the long-term capital gains tax structure, the government may revise the base year for computing indexation benefits. Manishi Raychaudhuri of BNP Paribas says, investors seem worried about potential tax levies or an increase in LTCG rates in case targeted consumption subsidies to the poorest sections are provided as the general elections of 2024 draw near. Additional tax surcharges or a possible hike in the long-term capital gains tax could dent investment sentiment considerably. On Wednesday, news flow around COVID-19 cases in China, oil prices, and US Fed Chair Jerome Powell's speech will be tracked by the markets. Back home, Q2 GDP data and infrastructure output print will be awaited.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.